Centralized cryptocurrency exchanges have spent years trying to separate their operation from illicit asset movements and international law enforcement actions. However, the boundary between unregulated global trading and national security concern has permanently blurred. On May 26, 2026, the United Kingdom government took the unprecedented step of formally blacklisting Huobi Global SA, the corporate entity operating behind HTX, or Huobi Trading Exchange, which stands as one of the largest digital asset exchanges in the world. This enforcement action marks a historic escalation, making HTX the very first major global cryptocurrency exchanges to be targeted under the UK's severe economic sanctions framework. Today, we are going to look closely at this development. We will analyze exactly what HTX is, review the prominent leadership behind the project, break down the specific geopolitical and on-chain allegations that triggered the sanction, examine how rival exchanges like Bybit are responding, and evaluate what this development means for the long-term survival of the platform and user capital. To understand the significance of this blacklisting, we first need to look at the history of HTX. Founded originally in China in 2013 under the name Huobi, the platform grew rapidly to become part of the dominant Big Three Chinese exchanges along Binance and OKX. For nearly a decade, it served as a primary liquidity hub for millions of retail and institutional digital asset traders across Asia and the global markets. Following China's sweeping domestic ban on all cryptocurrency transactions in 2021, it migrated its legal infrastructure to offshore jurisdictions, including Panama, and officially rebranded its global trading services as HTX. Today, the platform operates as a high-volume venue, handling billions of dollars in daily spot and derivative trading volume while utilizing the HTX DAO token as its core ecosystem assets. The operational strategy and public direction of HTX are driven by one of the most visible and polarizing figures in the entire digital asset industry, billionaire tech entrepreneur Justin Sun. Sun is globally recognized as the founder of the Tron blockchain network and a highly active market participant across various decentralized protocols. While HTX officially claims to be structured independently under a decentralized autonomous organization model, Justin Sun functions as the platform's core global advisor, primary public spokesperson, and a major financial backer. Sun's massive personal profile and global connection have historically helped his ecosystem navigate localized compliance pressures, but they have also placed a permanent spotlight on HTX capital movements, drawing intense scrutiny from Western enforcement authorities. The sanction package was officially announced by the UK government's Foreign, Commonwealth and Development Office as part of a targeted enforcement actions against 18 separate individuals and entities operating within what authorities call the A7 network. Specifically, the UK government has placed an absolute asset freeze on Huobi Global SA, the Panama-registered entity that serves as the corporate backbone for the online exchanges. According to official government filings and blockchain intelligence report compiled by Chainalysis, UK authorities allege that HTX actively served as a primary financial node in a shadow payment network designed to help Russia evade Western trade blockades and economic restrictions. Investigators state that the exchange channeled over $1.5 billion back into the Russian war economy. On-chain data indicates this was achieved by routing capital flows to previously blacklisted Russian platforms like Garantex and GreenX, while facilitating cash outs for a Russian ruble-backed stablecoin named A7A5. Supporting analysis shared by Global Ledger reveals that between 2021 and May 2026, HTX processed over $7.6 billion in high-risk Russia-linked flows and darknet market transactions, making it a direct target for Western regulators looking to choke off illicit financial rails to Russia. When a global cryptocurrency exchange faces explicit state-level sanction, the reaction from rival platforms is immediate and defensive to prevent regulatory contagion. In the hours following the UK announcement, rival exchanges Bybit rapidly moved to distance its platform from HTX operations. Compliance experts and industry analysts have warned that because Western governments maintain the power to command stablecoin issuers like Tether or Circle to freeze assets tied to blacklisted addresses, peer exchanges face significant USDT and USDC freeze risk if they continue routing high-volume transactions with sanctioned counterparties. At the same time, peer networks like Binance have begun warning their user base regarding potential checks, processing delays, and absolute risk control restriction when users attempt to execute direct token transfer between HTX and external platforms. In the landscape of international law and sovereign enforcement, national security sanctions are historically long-lived and exceptionally difficult to reverse. When a major government enforces an asset freeze under a trade blockade evasion framework, the decision is not a minor administrative infraction that can be resolved by paying a compliance fine. This designation imposes strict criminal liability on any UK citizens, business, or global banking partner that provides financial service or economic resources to the targeted entity. Because global banks must strictly comply with international blacklists to preserve their clearing licenses, HTX access to traditional fiat banking networks and regulated settlement channels is effectively severed. Barring a massive shift in global geopolitical relationship or a successful multi-year court appeal by the exchange legal team, these sanctions are permanently structural bottlenecks. In response to the UK blacklisting, the management team at HTX issued an official statement arguing that the regulatory designation applies strictly to Huobi Global SA as an independent legacy corporate entity. The platform emphasized that its current global exchange infrastructure, asset reserve, and user trading features remain completely normal and unaffected. While retail users have confirmed that standard on-chain withdrawals continue to process smoothly without immediate freezes, the long-term future of HTX faces massive operational headwinds. Even if the platform manages to legally isolate its current web interface from the blacklisted Panamanian entity, automated on-chain compliance software used by institutional market makers such as Chainalysis and OKLink will flag HTX deposit addresses as high-risk compliance nodes. This threatens to gradually cut off HTX from institutional liquidity, leaving it to function in a restricted, unbanked ecosystem, especially if other Western jurisdictions choose to mirror the UK's enforcement action. The blacklisting of HTX by the United Kingdom demonstrates that the era of regulatory exempt centralized cryptocurrency trading is reaching its technical limits. While the exchange attempts to maintain standard daily operation for its retail trading base, the geopolitical reality of being officially designated as a node in an illicit shadow financial network severely restricts its capacity to grow on the international stage. For market participants, it serves as an important reminder that centralized exchange custody always carries sudden operational and sovereign risk. Thank you for watching this educational data breakdown, and if you appreciate clean, objective financial analysis free of market hype, please consider subscribing to the channel. Share your perspective on exchange regulation and global sanctions in the comments below, and I will see you all in the next video.